We're going to turn to an economist's view now. We are very lucky to be joined by the chief economist at RSM for UK and Ireland. Please give a big welcome to Thomas Pugh.
Right, good morning everyone. It's lovely to be back. Right, before I start, Harry, do you have your notes from last year? Do you remember what I said last year?
We hung on every word.
Hung on every word. Brilliant. In that case, everything I said was completely true. In all seriousness, no, what I did say last year was, we were probably through the worst of it, things were going to start to pick up, and I think you may all be sitting there thinking, well, that was a bit daft, wasn't it? Because it doesn't feel like that. But actually, and this may be a bit shocking, growth in the UK, first half of this year, pretty good, actually. So growth of over 1%. Put that into context, that's about as much growth in the first half of the year as we got in the whole of last year. Growth first 8 months of the year, 1.5%. That's twice as fast as it was previous years. So actually, there has been a step change. There has been an improvement in growth over the last couple of years that, to be honest, I don't think you will see in the media. And this is a point I make whenever I speak to financial journalists, that actually a lot of the doom and gloom is their fault. And this it's not just government spending. If we look at consumer spending, 2/3 of the UK economy, probably the most relevant thing to most people here. When I was here last year, we had been dealing with consumer spending growth falling, negative 1% or something. It's now picked up pretty steadily up to 1%-ish. Now, all right, we can say 1%, it's not exactly booming, it's not stellar, but I think we'd all agree 1% growth is a lot better than a 1% contraction. So there has been an improvement in the economy. Well, there's been an improvement in the economy so far this year, because what we are getting is a little bit of a sense of déjà vu. If you remember last year, really strong growth in the first half of the year, and then everything kind of flatlined. We had the UK election, we had the US election, we had that big scary budget with the fiscal black hole, the prospect of tariffs, etc., etc. I think the risk is that we're seeing something similar. Strong growth in the first half and things looking like they're flatlining. And I think hopefully you'll all forgive me that I've not updated this for the data that we had at 7 o'clock this morning. But growth in Q3, just 0.1. So I think we are seeing a bit of a repeat of this. And it's not particularly difficult, I think, to kind of understand why. We're facing another budget, another big budget. It's depressing business sentiment, consumer confidence, although actually consumer confidence hasn't been as bad. Although given Rachel Reeves' speech last week, I suspect when we get the next set of data, that's going to be a lot more negative. You look at the housing market, activity has ground to a halt, the labour market, unemployment rate is going up. That's at least partly because employers who were burnt pretty badly last year are not willing to take risks ahead of the next budget. So I think we are looking at a real kind of slowdown in growth in the second half of the year, at least partly driven by worries about what's coming. And I think there are some pretty good reasons to be worried. So don't worry, this bit will be a bit depressing, and then I will try and bring it back afterwards. So if we look at the kind of numbers that we're talking about, that we're thinking about for this budget, remember we started off with this nice 10 billion fiscal headroom. Interest rates aren't too bad actually. It's a bit of a wild card. The big one is, we get into the bigger ones now, that benefits U-turn, that costs them about 5. The big one is this OBR productivity forecast downgrade. That probably costs you about 20. Then we get into some more benefits, and we get into the removal of things like VAT on energy bills. The total, I think, is that we're looking at, just to get back to our starting point, about 30 billion of tax rises. Now, you probably don't just want to get back to that 10 billion, you probably want to go a bit further. So I think we are realistically looking at 35 billion. We can have a nice range between 30 and 40. I think that's probably realistic. Putting that into context, the last budget was 40 billion. That was the biggest tax-raising budget in a generation, possibly ever, and was supposed to be one and done for this Parliament. So we're looking at something, I think, of a similar order of magnitude. So I don't think it's surprising that we're seeing a lot of nervousness out there. Now, I'm not going to stand here and try and predict exactly what the budget is going to look like, mainly because I'm quite reliably informed that the Treasury doesn't know exactly what the budget is going to look like yet. So, we're not going to go through each one. But there are some kind of broad principles that I think they're going to have to stick to that are going to help inform at least the makeup of the budget. So the first is you've got to stick to those fiscal rules. So we need to get back to at least 10 on the headroom. I think that's fine. I think they've been pretty clear about that. The advantage of going further, though, so why you would go from 10 to 15 or 20 is that it buys you credibility with financial markets. So your borrowing costs come down. That's helpful. But I think more importantly, it gets us out of this constant confidence-sapping speculation every 6 months about which tax rise is going up every time the wind blows the wrong way. So I think, yes, it will be painful to go a little bit further than perhaps you really have to. But I think the payoff is probably worth it in the longer term. So that's the first thing you've got to do. The second is it's got to be credible. So what I mean by that is, unfortunately, it's really got to be driven by tax rises because we know that they're not going to be able to get significant spending cuts through Parliament. You do a little bit, but the bulk of it has got to come through tax rises. And you can't really pull that old trick of everything's going to be fine for the next couple of years, and then when we get to the end of the decade, to the end of the Parliament, we're going to have some really big tax rises and we're going to have some big spending cuts. We don't have to do anything now. No one's buying that anymore. It's not credible. So unfortunately, that means we're probably going to have some pretty big tax rises coming in next year. So that's the second thing. The third thing is you've got to try and raise the money in the least economically damaging way possible. So maybe we can have this, maybe there might be different views on this in the room, but from an economic point of view, what that means is focusing on taxes that aren't inflationary, so things like income tax, things that aren't distortionary, so again, things like income tax, perhaps some property taxes, that kind of thing. And you've got to stay away from things that really push up inflation, so things like employer or really business taxes in general, VAT, that kind of thing. And you've got to stay away from things that are really distorting. Because the last thing you want to do is have a budget which pushes up inflation and causes something like a lot of job losses in the market, for example. That wouldn't be a good budget. I'm relatively optimistic on those points because the kind of, the messaging we've had from the Treasury is, the budget is going to be deflationary. They've learned from the lessons from last year. They're not going to repeat that kind of, the kind of big employers' taxes that we had last time. So I think if we can tick all those three boxes, I won't go as far as to say it'll be a good budget because it'll be pretty painful, but I think it will be better than last year. So let's look at a couple of extremes, I guess, a couple of options. One is that we get something that looks like this: big increase in income taxes, pretty simple, pretty straightforward. From my point of view, this would be great. It's not distortionary, it's deflationary, it's really easy to model, you know exactly how much money you're going to get. And what's more, it tells financial markets, tells people like me, that you're putting economics ahead of politics. So if we get something like this, I think it will go down pretty well. There is, of course, a tension here, because if you're doing something like this to satisfy financial markets, you are going to upset your taxpayer base, because it's a big increase in taxes. There is an undeniable trade-off here. And of course, the big cost, if you're a politician, is that you've got to break the manifesto. So I think the other option is really that we get something that looks like this, which is just a whole array of other taxes. They're looking at 100 different taxes. You can do this. You can raise 30, 35 billion without breaching the manifesto. That's fine. Very difficult to do it in a way that's not inflationary. Impossible in a way to do it in a way that's not distortionary. So the risk here is that if you're trying to stick to the manifesto, yes, you can raise the money. It doesn't have to be particularly inflationary, but you do risk having some unintended consequences to the economy. It wouldn't be my preferred way of doing it, but I suspect in reality we're likely to see something in between these two. So we'll see what we get. But if we get a budget which is, in the region of what we're talking about, is deflationary, it will be painful. It's going to be a big hit to consumer income probably next year. But there will be some kind of longer-term payoffs. So this is where it gets a bit more positive, trying to anyway. So the first is that actually inflation should come down. Almost 4% now. It could come down to about 2.5% by the towards the end of next year. Now, that might be little solace to a lot of people, but actually, if we think about real incomes, then a fall in inflation will help that. So when we're talking about that 35 billion in tax raises, well, actually, if 5 or so of that goes towards cutting energy bills, reducing inflation, a bit more on benefits, actually, that's not so worrying. That's not kind of a net loss to the economy. It's more taken from one and given to the other. So we're not too worried about that. As a side note, though, while we're just talking about inflation, I just wanted to point this out, really. So that white X there is total prices in the economy, CPI basket. And you can see we've got retail goods inflation trending well below total. We've got restaurants a bit above, and we've got hotels quite significantly above. So I think this says a couple of things. It says something about, the cost pressures that have been coming through on the industry. But it also says something about the industry's ability to pass those costs on, which has really been, quite frankly, quite impressive, and actually has led me to get my inflation forecast wrong a couple of times. So thanks for that. But it does raise the question about if we are going into a world where inflation is no longer 4%, it's closer to 2%, how much longer can we keep seeing really outsized gains in restaurants and hotel prices? I don't have the answer, but I thought it was worth a mild diversion. So, the other thing that I think is a positive, or at least will offset some of this pain, is that household savings, or the household saving ratio, which is basically the proportion of household incomes that they save, has been really high recently, and it's been high for quite a while now. It's about as high as after the financial crisis, which is really quite unusual. So we've got this big increase in taxes coming. That's going to hit real incomes. But actually, there's room here for people to just save a little bit less to offset some of that hit. So we're not thinking there's going to be a kind of one-to-one hit from incomes to spending. That's a bit of a cushion there that could come through. The other reason, I think, to think that actually household savings might come down a bit is that interest rates are going to come down. Now, I'm pretty sure, there's no wood here, but close enough. Pretty sure we're going to get a rate cut in December. I think that's pretty much nailed on now. The question is, when does the next one come and how many more come? If we get a big deflationary budget, like has been hinted at, like we've talked about, then actually you could see interest rates going closer to 3% by the end of next year rather than the 3.5% that we've currently got modelled in. That will be a big boost to the economy. It will be another reason for households to save a bit less, spend a bit more. It will take a while for that to kick in, obviously. It's not going to happen immediately. But by the time we get towards the end of next year into 2027, you will start to see the impact of that. Finally, well, not finally, but the other reason I think we're going to see household savings come down a little bit is because consumer confidence should start to improve. So here we've got, we call it the misery index because economists are famed for being so optimistic about absolutely everything. But essentially what it says is consumer confidence is driven by the things consumers care about. So things like inflation, house prices, the unemployment rate, interest rates, et cetera, et cetera. Stick it all into a model. And actually, once you I think we'll probably have to get through the initial budget shock. I wouldn't be surprised if consumer confidence falls over the next couple of quarters. But once we get into the second half of next year, and we're talking about inflation falling quite sharply, interest rates coming down, house prices, the housing market really starting to kind of pick back up again, actually we should get quite a nice increase in consumers should be a bit less miserable, I think, going forward. Yeah, and people always snigger at that, but I don't know if you can see it properly, but essentially consumer confidence in the UK is always negative. We are a structurally miserable country. So I talk about consumers being less miserable. I think you have to get into positive consumer confidence before we talk about happy consumers. So to kind of sum up everything that we've kind of talked about so far, one of the really unusual things that we've seen over the last couple of years is a really big increase in household incomes. It's up 5 or 6%, but consumer spending is only up 1%. So that leads to that big increase in saving that we talked about. So there will be a hit to that household income from the budget, but it doesn't necessarily mean that we get an exact same hit to consumer spending. And in actual fact, I think if we kind of fast forward through the first half of next year, because I think undeniably that's probably going to be a bit tough, and we look into the second half of next year and really into 2027, if we think about the foundations that are there with inflation 2%, interest rates being close to 3%, households have a decent stock of savings built up, the kind of foundations are there for consumer spending to really start to ramp up, especially if we get out of this cycle of constant worrying about what tax rises are coming next, what's the next disaster that's coming. So this, it might be a bit optimistic, but I do try and sit on the more optimistic end. Saying that, let's spend a couple of minutes talking about where it all might go wrong if you weren't depressed enough. I mean, one is simply that we could be completely wrong on the consumer confidence stuff. You know, consumers have been very nervous for a long time now. Understandable why. There's no guarantee that that picks up, even if inflation falls and interest rates fall, et cetera, et cetera. There is the risk of another bad budget. I think this happens really in 3 ways. One is that estimate of 30 to 40 billions could be way off the mark. You know, we could be looking at 50, in which case we're looking at a much bigger hit to the economy. 2 is they could come out with something that's uncredible. Gilt yields in financial markets have fallen quite sharply in the last couple of weeks on the expectation that the budget is deflationary and credible. If it doesn't hit that mark, I'm not going to say a Liz Truss 2.0, but we might be looking at something not a million miles off. The third way is we could have a repeat of something that looks a bit like last year, you know, distorting, inflationary. Of those 3, I think that's the biggest risk, that in a real effort to stick to the manifesto, you end up with policies that don't really make sense economically. We've been kind of laser focused on the budget and the UK, but don't forget there's a big wide world out there, and you know, trade wars are brewing, real wars are brewing, as we heard kind of are still going on, as we heard at the start. There's a risk there of things flaring up again. And then finally, I'd be amazed if anybody hadn't heard about AI bubbles and that kind of thing. There is a real risk that if equity markets tank sometime in the next year, that will not be good for consumer confidence. It will not be good for household wealth or spending. I should just say, if it does go pop, it's far more likely to look a bit like the dot-com crash than the financial crisis. So kind of a financial market issue, not necessarily a real economy issue, but it wouldn't be good for anyone. Finally, in the last couple of minutes, I wanted to finish on a real positive note, because it's easy to think about risks where everything go wrong, but let's think about things where actually, what's on the upside. Well, first of all, we could see some much sharper and more significant cuts from the Bank of England. we've kind of got this nice gradual glide path in. But if we get a big deflationary budget, we could see pretty consecutive and sharp cuts in interest rates that would have a much bigger effect on, a positive effect on demand. Second is, just as we might be way off the mark in the bad direction, could be way off the mark with the budget on the other direction. Actually, if the fiscal hole turns out to be 20, you don't really need massive tax rises to fill that. You can backload a lot of that. It looks a lot more comfortable. And actually, we've all kind of been panicking over nothing. That's an option. The wild card here, I think, is oil prices. We've already seen them fall quite sharply. For those that follow, I spent a fair amount of my career following this kind of stuff. Oil storage is basically overflowing at the minute. I wouldn't be surprised if we see oil prices starting with a 5 by the end of the year or early next year. That reinforces that kind of falling inflation story, positive, will offset some of the hit to incomes there. And finally, we almost got away without talking about AI, but we could be staring down the barrel of a kind of an AI productivity revolution. If my experience is anything to go by, every time you do a significant downgrade to your forecast, everything starts to pick back up again. So if the OBR dramatically cuts its productivity forecast, we could well be looking at a significant revision in the future. Now, I don't think that's realistically the next couple of years, but if we look out towards the end of the decade, then that's where we could start to see, I think, some impact of the productivity forecasts. Right. So I hope that wasn't too depressing. I don't know if we've got time for questions or not, but...
Well, let's say we've got time for one really excellent question. Put your hand up. Can you hear me? Yes.
Hello, Thomas. You're in a room here of 400 hoteliers. Unintended consequences were clearly part of the budget last year for the hospitality industry. And probably since you started your talk, another hospitality industry has closed down. We're at 5% unemployment. Hospitality jobs have dropped enormously. You mentioned the increase in income on hospitality, but the massive increase in labour cost, the NIC threshold, which is one of the bigger problems for short-term staff, etc. So I think, what confidence could we even have that the Whitehall have any idea about unintended consequences? Because clearly what they did last year to one of the biggest sectors in the country has damaged our sector disproportionately. Those businesses will not open again. So what is the answer for this year? What's she going to do this year?
I completely agree with you. And I said at the time, if you wanted to raise that kind of money, which again is a political decision, doing it in the way they did it was probably the worst possible way they could have done it. I mean, you have to think really hard for a more economically damaging way to raise significant sums than what they did. So I'm completely with you there. The reason I think we are more optimistic this time is that all of the messaging we've had from the government suggests that they have learnt from last year. The focus on kind of reducing the cost of living, on reducing the burden on businesses, bringing interest rates down, that all tells me that they have, they're not going to try and make those same mistakes again. Now, to be honest, I don't know how much solace that will be, because you've been hit very hard on what we'd think of as the supply side last year. If we get a big rise in income taxes, for example, well, that's going to hit on the demand side. So it is a tough environment. I'm not going to try and sugarcoat it. Yeah. But like I said, I think if it does stabilize the public finances, if it does bring interest rates down, if it does bring inflation down, we will go through a soft period or a weaker period next year with the potential for much higher growth 27, 28. Now that's probably little comfort for those over the next year, But realistically, I think that's where we stand. Right, I'll be hanging around, so if anyone wants to grab me later, please do.
Thank you, Thomas. I was listening very carefully. You seem to be saying to us that things might get better, but they could get worse. So thanks for that.